Hello, Mr. Ng. Today I will be sharing with you about AREIT's Real Estate Investment Trust Company Analysis. Firstly, I will be sharing with you regarding the corporate information. AREITs accounting for 15% of Singapore's listed REITs, which was listed on 90th November 2002, which has originally portfolio of 8 properties worth 595 million Sing dollar. It is Singapore's first and largest listed business-based and industrial real estate investment trust with a diversified portfolio of 103 properties in Singapore and 2 business park properties in China as of 30th June 2014. AREITs holds a customer base of around 1,300 international and local companies ranging from industry and activities including research and development, life sciences, information technology, engineering, and many other more. Since its initially public offering in November 2002, AREITs has been paying out 100% of its income available for distribution. The screenshot below will show the weightage of various industrial contribution to the sales itself. As for the geographical segment of this investment, we can show that AREITs has been actively seeking investment opportunity in emerging market in recent years. The company have a portfolio in China comprising 2 business park property, one of which is located in Beijing and another one in China. However, as you can see in the pie chart itself, the majority of the sales are still contributing by the Singapore properties. As there are 103 properties in Singapore compared to 2 in China. AREITs has been actively involving in acquiring to grow its portfolio throughout the years. In recent years, in year 2014, in the month of August, it has acquired the High-Flux Innovation Centre and it also joins the AREITs. It also joins the FTSE Straits Times Index as one of the 30 founder stocks. Next, I will be moving on to talk about the fundamental analysis. It is a process of getting a better understanding of a company's performance, future prospects, competitors and its marketing and its market environment. It involves analyzing and interpreting annual reports, financial statements and other aspects of a company, which includes expenses and profit margin. Firstly, I will be talking about the valuation ratio. As for the price to book ratio, it is used to compare a stock's market value to its book value. As shown for the table above, below, the AREIT's PB ratio has dropped from 1.3 to 1.2 in recent 2012 and 2011. This is because the stocks have becoming more undervalued as the book value of the company has grown over the years. However, the stocks might not be attractive to investors as compared to its peers who have lower PB ratio. A low PB ratio will mean that the stock is undervalued. Next, I will be moving on to talk about the PE ratio. As you can see in the table above, AREITs has been outperforming its peers in the industrial REITs sector for the past 12 months. The higher ratio will mean that the investors are anticipating higher growth in the future. This is due to the fact that AREITs has been aggressively in acquisition in recent years. The recent addition in August saw them acquiring a newly completed integrated mixed-use of development for an amount of 458 million Sing dollar. Its strategic location near the CBD means it is highly accessible and it is open and is attracting well-known companies such as Intel, Audi, or even McDonald's. This move continues to encourage investors that AREITs will continue to diversify its portfolio and add on to their anticipation of future growth. However, AREITs still fare below the average sector performance This is probably due to the fact that the Singapore economy has been slowing down in recent years, causing the demand for property for property users to suffer. Moving on, I will be talking about the gross margin. A gross margin is a total sales revenue minus its cost of goods sold. As we can tell from the table above, the gross margin has been showing a steady decrease from year 2012 to year 2014, where it is expected to continue to decrease. As this is probably due to the fact that higher operating expenses caused by higher maintenance and also higher profit tax expenses started to kick in. Moving on, I will be talking about a profit margin. A ratio of profitability calculated as net income divided by revenues. Profit margin is very useful tool when comparing companies in similar industry. A higher profit margin will indicate a more profitable companies that has better control over its costs as compared to its competitor. Over the years, AREITs has been growing its portfolio, as you know. However, in recent years, due to government cooling measures such as introducing seller's stamp fee and a rising cost of land, resulting in a huge increase in costs and expenses. As a result, AREITs, being a company with huge market capitalization, are severely hit and is reflected in the ratio itself. Moving on, I will be talking about the return on equity. The return on equity is net income divided by shareholders' equity. As from the table itself, we can know that the return on equity has not been so attractive for AREITs, as we can see that the ratio is much lower as compared to its peers. This is probably due to such a drop in ROE. This is probably due to one of the reasons, which is because in 2011 to 2012, there's an increase of number of shares issued from 1,874 million in year 2011 to 2,085 million in year 2012. Moving on, I will be talking about the performance of AREITs as compared to its benchmark and its peers. As seen above, with light blue representing the peer index while the orange representing the SCI index, you can notice that the past 1 year, AREITs has not been performing as compared to its peers and the benchmark, which is the SCI index. Moving on, I will be talking about the leverage ratio. The debt to equity ratio in the table above shows that the debt to equity ratio has been dropping since 2012. This is a positive outlook, as we know that it shows that the company has reduces its reliance on financing its investment with debt. A higher debt to equity ratio generally means that the company has been aggressive in financing its growth with debt. This can result in volatile earnings as well as additional interest expense. Moving on, I will be talking about the interest coverage ratio. The lower the ratio, the worse it is, because it shows that the company are burdened by interest expense. Overall, in year 2013, there's a sharp decrease in the ratio because the company are engaging in mega projects such as acquiring business park in China, which causes, as this acquisition need to be funded by leveraging, that's why the ratio is dropping. And the total debts from 2012 has been increasing to year 2013, as the figure moved from 1,971 million to 2,400 million in 2013. Furthermore, the percentage of fixed debts inside the total debts dropped from 74.8% of 2012 to 55.8% of 2013. This means that the company are exposed to market volatility, which causes interest to increase. This could be the reason behind the decrease in ratio. Moving on, I will be talking about the aggregate leverage. As you can see in the table below, above, as compared to its peers in the industrial REITs, A-REITs has a relatively low 31.6% aggregate leverage. These 7 REITs, as I showed in the table above, maintain an aggregate leverage of 32.6%. Therefore, the ratio of A-REITs is significantly lower, and it shows that A-REITs financing are healthy, as excessive leverage will increase the risk of company running into cash flow problem due to interest expenses. Furthermore, the release by A-REITs recently showed that there was a debt headroom of around 1.1 billion before its aggregate leverage reaches 40%. This means that A-REITs are still able to capitalize on market opportunity when it occurs. Moving on, I will be talking about the SWOT analysis of A-REITs. The strengths of A-REITs will be its experienced business units due to its presence in the market for more than 30 years. However, the weaknesses will be the future profitability, which is called into racial question. As shown in the previous analysis of return of equity, we can tell that its return of equity in the past 3 years has not been desired, as it is significantly lower than its peers. As for the opportunity, A-REITs certainly are explored to growing opportunity due to its venture into the emerging market of China, and in the next 10 years, China will continue to want to stimulate its economic growth, which means that the demand for industrial space will increase. With such a vast experience that A-REITs have, it will certainly be greatly demanded by local industrial players, and industrial players want to venture into the China market. As for the threats, A-REITs core business are still located in Singapore, and in recent years, the government tightening of foreign labours will be increasing the labour costs. The global economy also face uncertainty in the short term, as crises in Gaza and Ukraine remain unresolved. In conclusion, taking into account all of my analysis, I noticed that the overall long-term outlook for the company remains bright, as the company has an competitive edge due to its expertise that has built up over 30 years. This is vital in order to maintain the growth and stability of a company. Its ratio, like the aggregate leverage, also shows that the company has not gone into aggressive leverage, which causes destabilize of the company itself. However, in the short term, profitability certainly came to question, as a profit margin and a ROE are not desired in the past 3 years. As for my recommendation, I will recommend investors with minor or moderate risk appetite to invest in A-REITs for the long term. As you can see in the table above, as compared to other financial instruments such as the CPF ordinary account, 10 years Singapore government bond, A-REITs still yield much more attractive returns. However, for investors who are seeking higher return, I will encourage him or her to invest in its peers like Mapletree Industry, which is giving a return of 16.3%. With that, I will end off my presentation. Thank you.